software as a service. Hi guys, welcome aboard. What we're looking at today is the SaaS fundamentals training exercise. So this will be a comprehensive build of a rolling historical forecast model. There's going to be multiple pricing models in there, going to be loading up some historicals, getting some forecast numbers scheduled out quite nicely. And basically, creating that ideal kind of SaaS rolling historical forecast planning model. So in terms of process, what you're going to need here is the assumptions file, which you should be able to get from the Modano website. Now, in terms of prerequisites, you don't have to have done a whole stack of work before you dive into this SaaS fundamentals training course, but it probably is quite beneficial if you have sat through at least the forecast only model and maybe had a look through some of the historical forecast course, just to understand the more fundamental structure before getting into some of the more hardcore analysis here, particularly around that historical forecast, derivation of historical metrics and things like that. Now, in terms of the assumptions file, there's three main aspects to that. So there is a historical section, which includes both historical financial information as well as historical operational data. There's also a forecast set of numbers, and again, these are a mixture of financial and operational volumetric pieces. And then there's also an all periods piece, which looks at something called cost to acquire a customer, which we will get into shortly. Now, in terms of the build process, this is going to be pretty familiar to regular Modano users. So we're just going to go up to the Modano tab and click on the new dynamic template. And in terms of the starting model that we're going to run through here, we're going to use the SaaS financial model. Obviously, we're going to use chart of accounts 2. We'll have a look at some of the scenario stuff later on, but as a starting model, let's get that kind of SaaS chart of accounts 2 as our starting model. And in terms of the secondary characteristics, what we're also going to run with here is we're going to assume that it's a United States entity. We're going to assume that we're going to run with single component analysis, and we are going to exclude the sales tax side of things. So in terms of what we've done with the SaaS library, we've updated all this for a few additional chart of accounts, but we've also got a big differential there around things like GST, VAT, and the US sales tax. So a little bit more firepower in terms of what the SaaS content library now does. So if you want to open up that model, we will get started. Now, in terms of getting started, usual kind of process, we are going to enter an entity name. So we're going to call this Alsatian Software Limited. And in terms of the model name, we're just going to generically refer to this as the SaaS financial model. So nothing too complex to start with. Now, after you've done this, what we want to do is hop across to the time series assumptions, and we're just going to check that the starting model has the right kind of duration and structure. So for us, we're going to assume that there's a 1st of January 2020 start date. We're also going to assume that there's 12 historical, 12 forecasts as a split of last historical month and forecast analysis. And this model, we're also going to set our denomination to thousands. So whilst there is some single unit, single dollar assumptions in there, all of this will be converted across to thousands in terms of the outputs. Now, by default, the SaaS financial models all open with 3 dedicated revenue modules that are related to uncontracted or uncommitted users. They're what we refer to as the rates users SaaS revenue mechanism. Now, in terms of what that represents in the real world, this is kind of if you think about Netflix, this is your Netflix business model, whereby all of the users are identical. They all sign up to a certain price. Everyone is consistently on the same price, but no one is committed. So at any point in time, any user can churn out. And in terms of that revenue mechanism, if we change the pricing, everyone changes at the same time. Now, as a first step, let's just hop across to the historical income statement, which is position 2A via the table of contents. And we're just going to change that first revenue category heading to uncommitted monthly users. We'll come back to the historical information shortly, but as a next step, let's start to get the forecast analysis kind of built out. So hop back to the table of contents, and what we'll actually do is move across to the revenue sheet, which is 2C via the table of contents. And what we're going to do is copy and paste across from the assumptions file the leads and conversion rates into our forecast analysis. Now, once you've done this, just confirm that the closing users at the end of December 2021 are 25130, and that way you'll know you've transferred this information in correctly. Now, in terms of what this information represents, this is where the value of SaaS businesses starts to become apparent. So a lot of people in the SaaS world talk about the funnel, and what the funnel represents is how am I getting my users on board? What am I spending to create new leads? What is my conversion rate of getting those leads on board? What am I then doing with those users in terms of monetization and retention? So in the first instance, what we've done here is enter a sequence of leads based on what we think our staff operationally might do, or what our social media campaign might achieve. And then off the back of that, we're also assuming that we're going to have a certain conversion rate across to new users. So you can see the new users down below in row 56, and all things being equal, that is basically what we're assuming in terms of how we will onboard people. Now, in addition to kind of explicit activity that will generate leads and conversions, that a lot of SaaS businesses also have a degree of kind of viral activity. And to this extent, we might also want to include some sort of forecasting mechanism that allows us to kind of project how our current user base might spread the word about our business or products. And that's really what the additional growth in users assumption is kind of designed for. So we'll transfer the assumption across from the assumption file into our model. Now, obviously, there's a risk of double counting here. We might be kind of implicitly counting the growth in the business twice. We'll just assume that in this particular instance, whoever's created the assumption, so a chief revenue officer or something like that, will have actually thought quite explicitly about, okay, what is the growth in dedicated lead generation versus the actual more viral spread of our current customer base kind of passing the word on. Now, in addition to the inbound kind of activity, there's also a big aspect of the SaaS world, which is related to churn. So if you've ever had a SaaS client or worked in a SaaS business, you'll know that the word churn is one of the most important metrics that you can have. It ultimately leads through to the kind of value of your customers. But in the first instance, it's related to kind of how sticky your platform is, how kind of sticky your product is, how much people like to simply hang around. So in the case of Netflix, the rate at which people cancel their service is effectively their churn figure. So we're going to transfer in some estimated churn numbers, and what we'll have a look at next is kind of what that means in terms of the overall projection of the model. So once you put those guys in, let's just check that our closing users at the end of December 2021 are now forecast to be 24,887. And what we'll now start to look at is the monetization of this user base. So in order to calculate the revenue that's derived from these users, the CEO has set the monthly rate for our kind of uncommitted monthly users at $60 per user per month. So we can either enter this directly or transfer it again across from the assumptions file. Now, one thing just to note, in terms of the monthly charge, these are override assumptions. So there's no default value, and it's assumed that you can change the prevailing rate by exception. What that also means though is you shouldn't enter zero. So what I wouldn't expect to see here is somebody entering zero, say for Feb 21, because that would actually communicate to the model that we're now making our ongoing revenue for our monthly uncommitted users free, effectively. So yeah, don't enter zeros in here. All you really need to enter are the assumptions by exception as definitive overrides. Just before we finish this process, just check that the end of December 2021's monthly revenue is 1518.4. And at that stage, we should have a fairly good set of numbers up and running. Now, in terms of this uncommitted monthly kind of users pack, this behaves like a fairly normal revenue module. So if you've looked at our historical forecast content before, you'll understand how these kind of flow through. The key thing here is that there is also kind of historical income statement revenue flowing through, as with normal revenue modules. That's also mixed in with kind of historical operational analysis. So in the first instance, let's get that historical income statement revenue kind of loaded up. And for this normal kind of process, hop back to the table of contents, we'll select the historical income statement and paste that information across into row 19. Once you've done that, let's head back to the SaaS revenue, again, 2C via the table of contents. And what we'll do is drop in our historical numbers and also just have a quick look at how that historical revenue number is flowing through into the all periods analysis of our SaaS historical forecast revenue. And this is an interesting point. Typically with our revenue analysis, the historical revenue will flow into a hidden area of a forecast revenue component. For the SaaS content, what we actually have is all periods analysis, because the historical activity and the historical derivation of metrics is quite a valuable part of how the overall model works. So unlike our normal kind of content, in this instance, there's quite a valuable historical aspect as well as forecast. And related to that, what we'll also do now is copy and paste our historical operational assumptions into the historical section of the uncommitted monthly users. Now, what we're talking about here is historical closing users, what our historical lead generation was, and also what our new users were. Now, importantly, what that then gets us to is a derivation of those historical metrics. So what was our user churn? What were we doing in terms of conversion rates? How did the business actually perform over that historical kind of period? What you'll also see is that in terms of the historical derivation of revenue, our monthly charge that we've worked out based on this historical information is implying a $50 per user per month kind of metric. And that kind of ties back into, hey, the CEO has come into us and said basically he's looking to change the price to $60 per user per month from January 21 onwards. And hence we've entered that new assumption by kind of exception. One other piece just to look at here kind of gets to the heart of why SaaS businesses are so valuable. So if we look at our closing users as at the end of December 2020, that is 2721, this is actually the starting point for our forecast. So if you think about the forecast performance of Netflix, there's two aspects to the forecast of Netflix as a business. One is forecast based on history, i.e. what is our closing user base? And the other is how aggressively can we go and find more customers? And, again, if you think about the size and scale of Netflix currently, it's going to be interesting to see what people say in a few years' time if Netflix crumbles. But if you think about the current size of Netflix, an incredible amount of their value is baked into the fact that so many people, as at today, are watching their service, i.e. their closing user base is an incredibly important driver of that forecast performance. Now at this stage, just confirm that the closing users as at the end of December 2021 is 27372, and that way we know we've got kind of the correct data loaded into the uncommitted monthly users module. What we'll do now is have a quick look at the historical users churn just to kind of understand how those historical data points kind of drop in. So for example, if we were to look at July 2020, you would see that in terms of our opening users, we've got 732 as our kind of starting number. That's based on our prior period historical closing numbers, obviously. We then got a leads figure of 5840, which implicitly has led to 255 new users. We can use that figure to understand what our conversion rate is, and we'll see a little bit of that later on when we get into some of the rolling metrics. And in terms of that actual user churn, what we can see is we have kind of 16 users have churned out in this period. And the way in which we actually work those out is to say, well, we've got 16 users churning out based on an opening user base of 732. That implies a 2.2% churn out figure. And even though, obviously the absolute numbers are interesting, a lot of the time churn metrics are always kind of rebased down to those percentage figures. Likewise for things like conversion rates and growth metrics and so on. But at this point, that's the completion of our kind of Netflix style rates users type mechanism. What we'll look at next is to kind of replace that second revenue module with something that has a contractual structure, so we can start to look at, instead of churn, an alternative metric, which is renewal rate. So that's the rate at which our existing customers on contracts are happy to renew those contracts. So for the contracted users, what we're going to do is hop across to the historical income statement, again via position 2A of the table of contents. And we're just going to update the second revenue category heading to contractual users. And we'll also transfer across the historical assumptions for the last 6 months. So again, copy and paste across from the assumptions file. And what we're now going to look to do is then to replace the module with something that will allow us to kind of model out contracted users. So just to kind of touch base on what a contracted user is, this is kind of like a gym membership. So in terms of how these users behave, they are typically signed up at a point in time for a duration. So a lot of the time we'll assume a 12-month contract, so an annual type contract arrangement. The users are usually struck at a certain price. So if I sign up to a gym at $100 a month, I would expect to be paying that $100 a month for the duration of that contract. So even if the gym becomes more popular and more expensive, my contract won't change from that initial point. Now I might have to then restart that contract at a new point. I will basically renew my contract, and I might then notionally have to renew it at the new higher rate, or depending on whether there's things like grandfathering, which we won't necessarily get into here. But in the first instance, we'll assume that ongoing rate is the point at which I restart my next contract. So contracted users, again, if you've got a gym membership, something like a telephone contract, this should be fairly self-explanatory. Now the next thing we have to do is to replace our module. So what we're going to do is hop to the SaaS revenue worksheet, 2C via the table of contents, and if we scroll down and select the second module, which is the contractual users module, this module has to be obviously replaced with a more applicable mechanism. So if you just head up to the Modano tab and click on the replace button and replace from web, what we'll look to do is to basically swap this module out. So in terms of the contract module, as you might be able to tell from the labeling, what we would select is the SaaS revenue users contracts module, and just click replace on that module. At the next window, just click the OK button. This brief message is just informing us that there's actually a new link out, and in this instance it's actually the renewal revenue that will be used in some of the slightly different metrics. So just click OK at the replace module button, and what that will drop in is an entirely new module based on a kind of contractual structure. So the first thing we'll do here is to just drop in the historical analysis. So what we'll do is transfer in from the assumptions file the historical closing users, the leads, all of the new users, and we'll also drop in a contract rate of $40 per user per month, which is applicable from kind of July 20. Now, if you have a look at the historical user data, what you'll see is that it's created a profile of new users. So we've got 388 new users in July 2020, 431 in August 2020, and so on. Now, the important thing here is that with a 12-month contract duration, we then roll forward, and what we're really interested in is when do these users become end of contract users. So as you would imagine, on a 12-month contract, somebody starting in July 2020 is then going to become an end of contract user in July 21, and it's these individuals that we're then going to subject to our forecast renewal rate. And what the renewal rates are basically saying is what is the probability that these individuals are going to sign another contract with us. So what we'll do is we'll transfer across again the kind of revenue projection assumptions from the assumptions file, and in this instance, you know, the chief revenue officer is anticipating a kind of 97% renewal rate. One thing just to note is that the renewal rate isn't the exact inverse of churn. So the renewal rate is actually saying for those customers that are due to come off contract, what is the rate at which they are going to be re-signing with us? Now, if you've got a 12-month contract structure, there's going to be a whole stack of users who aren't necessarily coming off contract. And therefore, to the extent that you have a very small number of lost individuals, that's going to be a slightly different percentage to the inverse of that renewal rate. So when you're working with these things, don't always assume that a 90% renewal rate equates to a 10% churn rate, because it isn't necessarily the exact inverse. Now, as I mentioned earlier, the interesting thing about contract structures is the fact that a contract is usually struck at a certain price at a certain point in time. So in this instance, at the moment, we look at our new contracts revenue, and we've got 120.4 as our kind of near-term forecast number. If we were to change our contract rate to, say, $45 an hour from January 2021, those numbers won't actually change. And part of the reason for that is that we're changing the contract rate, and that's the rate at which new contracts are struck. That has no impact on the revenue that we're receiving from the previously struck contracts. So that contract rate is an ongoing kind of prevailing rate. It doesn't apply to all individuals as it did in the kind of the simpler Netflix approach to the users rates module. Now, as with the uncommitted users, again, we've been given a stack of assumptions around lead conversion and user growth rates. So let's paste these in from the underlying assumptions workbook. And what we just want to confirm is that the number of users as at the end of December 2021 is 3,575. Now, up until this point, it's all been relatively straightforward from a modeling perspective, particularly around how we hit the financial statements. So in both the rates users and the kind of contract structure, there's no difference between when a customer pays for their service and when they get that service. So from an accounting perspective, we're hitting the P&L with revenue and we're getting the cash in the door. So there's not much complexity there. Once we start to move into the prepaid world, which is the next module we'll look at, it gets a lot more hectic. We start to look at things like deferred revenue. The accounting becomes a lot more complex. The accounting becomes pretty complex in just a normal kind of fluffy everyday SaaS model. If you're trying to model a SaaS business on a rolling historical forecast kind of approach, that deferred revenue will often stagger that historical forecast point. And speaking from experience, it's a nightmare. It's incredibly hard stuff to model and make kind of nice and fluid and well structured. Fortunately, we've done all the hard work for you. So what we'll have a look at next is the prepaid mechanism. And this is kind of a natural extension on from the contract structure. We're just getting the cash up front and releasing it to the P&L. So in terms of the mechanics of changing the model up, pretty comparable to dropping in our contractual users. If we just head across to the historical income statement, we're going to label up the third revenue category as upfront payment users. And again, similar kind of process. If you head across to the SaaS revenue worksheet, what we're going to do is select the upfront payment users module. And again, click on the Modano tab, click on the replace button, replace from web. And the module we want to use in this particular instance is the SaaS revenue users contracts prepaid module. Now, as you can see, once this drops in, there's a lot more complexity to it, particularly around that prepaid and deferred revenue kind of mechanism. Now, what we're going to do in the first instance is just talk very slowly through one single contract instance. So what we're going to do is head across to March 2021. We'll drop in an opening leads number, a conversion rate. We'll assume a 6-month contract duration, and we'll also drop in a prepaid contract value of $180. And so that we don't get contracts rolling over and over each other, we're actually going to assume that this immediate slab of contracts, nobody renewals. And so what we're actually going to do is enter our contract renewal assumption as 0. Now, if we have a look at the calculations below, what you can see is how this kind of impacts on the financials. So in terms of the revenue, we've got 1,000 people paying $180 over 6 months. That means we're going to be getting 30K in for that 6-month duration as an actual revenue recognition point. However, in terms of the actual prepayment mechanism, we're actually going to get the full 180 grand in at the start of those contracts. So May 2021, we're going to get 180 grand in from a cash perspective. Now, we don't want that 180 grand to just hit the P&L. So because we have this differential, what we ultimately end up doing is capitalizing it onto the balance sheet. And that's that row you can see in terms of row 144. It's the closing forecast deferred revenue profile. In the first month, 1 month's worth of the 6 month will already be recognized as revenue, and therefore our closing balance drops down to $150,000. And in each of the subsequent months, we reduce that balance by the 30K that's being recognized as revenue. I won't get into the debits and credits here, but if you're interested, there's obviously a world of information on the internet around the debits and credits side of things. We do tend to match those pretty closely in terms of how we flow these through to the financial statements. Now, if you hop back to the table of contents and select 2K, which is the financial statements themselves, we'll just kind of run through how that extension of the prepaid contract analysis then gets bounced into our financial statements. So expanding out the revenue, we can see that those upfront payment users is giving us a nice continuous profile of the 30 grand per month. If we roll down slightly further, what we can also see is in the middle of the balance sheet, in terms of that kind of liability side of things, the upfront payments users has also given us a prevailing forecast deferred revenue balance that's flowing through into our current liabilities. Now, if we scroll down to the direct cash flow statement, you can see that the cash flow is actually made up of the two parts here in terms of our income statement recognition and our balance sheet movement. So in terms of the 180 grand that we're getting in March 2021, that's a combination of the revenue that's been recognized as well as the increase in the deferred revenue liability. In the subsequent periods, the revenue is actually backed off against the unwinding of the deferred revenue liability to effectively create 0 cash receipt. So, and this kind of gets to the heart of the way Modano tends to approach that cash flow statement, is always trying to pair things off against assuming income statement is recognized as cash in the first instance, with the balance sheet then doing the work around the differential to get to ultimately the correct cash flow profile. So in terms of that deferred revenue, if you're new to this and not an accountant, I would definitely rewatch that section just to work through how the financial statements are being impacted with just one standalone set of contracts. What I'd probably even do is kind of zero out the other preceding 2 modules, so all you can see is just that prepaid mechanism and the forecast deferred revenue and revenue release associated with that prepaid structure. Because what we're now going to look at is something that's even more complex, which is kind of the real world example, which is in an ongoing business, those deferred contracts roll over each other. So what we'll now do is populate some more assumptions for this kind of contractual, for these kind of upfront payment users, and see how kind of complex the numbers become as a result of constantly layering, unwinding and new prepaid contracts on top of each other. So if you head back to the revenue worksheet, what we're going to do is copy in the forecast leads, conversions. We're going to drop in the contract renewal rates from the forecast sheet within the assumptions workbook. We're also going to remove the previous kind of prepaid contract data point. We're going to drop in the original contract value, which was actually set back as $180 in October 2020. Now, as you can probably appreciate, once you drop this in, the analysis becomes much harder to understand because there is a real cumulative aspect to things. Now, to try and unpick this and give a more worked example, what we might do is look at April 2021 in terms of what the closing balance and the actual revenue recognition is made up of. So in terms of April 2021, the closing deferred revenue balance is 417,360. And in terms of what's made up of that, that's going to have 2 of the 6 months of January 21's contract, 3 of the 6 months of the Feb, 4 of March, 5 of April, all kind of sitting there on the balance sheet ready to be released. So obviously by the time we get to the end of April, most of January has been used up, and therefore we've released a lot of that deferred revenue into the income statement. We only have 49680 kind of left on the balance sheet ready to be released over the next couple of months. As you can appreciate, in terms of what makes up that 417,360 number, there's actually a huge stack of cumulative numbers based on, when contracts were struck, how contract prices changed, and what the duration of the contracts is, and things like that. In terms of the revenue for April 2021 is 115,320, and that's made up of 1 month of each of those 4 kind of contracts. So we've got 1 month from Jan, Feb, March, and April itself flowing through to give you that 115 grand. And again, the disaggregation of the revenue is much more complex in a prepaid revenue structure relative to our Netflix model, where all we've got to do is multiply a consistent user block by a prevailing price. So yeah, as you can see, the deferred revenue mechanisms are pretty complex. Unfortunately, they're about to get even more complex because once you start to look at a historical forecast model, you're starting to get information from 2 sources. So in the current example where we've worked through April 21's numbers, they're all based on forecast activity. However, if you were to look at the kind of piece of April that's left over, there's also 1 month's worth of the 6 months contract struck in December 2020. So what we're going to do now is we'll hop across to the historical balance sheet, which is position 2 via the table of contents. We're just going to drop in what are the prevailing historical deferred revenue balances copied across from the assumptions workbook. Now, in this instance, we've actually got the 3 months of deferred revenue disaggregated. Unfortunately, when you do this in the real world, a lot of the time that deferred revenue is going to be just a single trial balance line that's probably going to have some highly specific release to the P&L. For us, we've got this disaggregation so you can see the contracts more readily. So with the historical data dropped in, let's hop across to the revenue worksheet. And what we want to do is unwind effectively that balance sheet amount. So for the October contract, we've probably got 3 months left. For the November contract, we've probably got 4 months left. And for that December contract, we've probably got 5 months of analysis left. So what we'll drop in is the recognition period for each of those contracts. And we'll have a look at how that then impacts the financials to kind of complete the other side of the square of information around the forecast revenue in the near term. Now, with our historical deferred revenue disaggregated, we can actually highlight certain sections to show how the closing deferred balance is made up and how it is subsequently released into the financials. So if we were to take any closing point in time, we should also be able to see, well, okay, in terms of the contract releases for October, November, and December, what is the total that's being created there in terms of the revenue still to be released? And we should be able to see that in terms of that historical closing balance. Now, in terms of what this historical balance sheet release is, this is a very fiddly kind of modeling structure. So a lot of the time we talk about unwinding the balance sheet. And in this instance, we are unwinding a balance sheet item into the financials. However, this unwinding isn't necessarily the revenue, because the revenue is actually going to come through pretty naturally from our underlying analysis. What we are unwinding here is actually the shield of non-cash receipt. Now, I can appreciate that that's a fairly subtle nuance. So what I recommend doing is we'll continue through the population side of things, dropping in the historical income statement information. So again, just copy in from the assumptions file. We'll also copy in the other historical information relating to the operational side of things. So historical closing users, leads, and kind of those new users. And what I would recommend doing is just have a look through that near-term forecast piece around that kind of Jan, Feb, March 2021 set of data, and just try and understand and follow through from a disaggregation perspective how those closing deferred revenue items are impacting on the financials, particularly around that kind of cash shield. So yeah, fully appreciate this is very complex stuff. Largely it's been automated, and you can just use this without necessarily understanding the hardcore 101 of it. But yeah, from a technical perspective, the unwinding is the cash shield of non-receipt that's being calculated to ensure that the forecast revenue doesn't translate to more cash inflow, because obviously that would result in a double count. Now, up until this point, most of the analysis has been done on what we typically refer to as fungible users. So we have a high volume of identical users. So in the case of Netflix, we have a lot of individual users. They are all being charged the same price. Even in the case of something like our prepaid analysis, we again might have a lot of identical users in each of the periods in which they're struck, what we often refer to as cohorts. They're all identical in terms of their nature. Now, a lot of SaaS companies will price their products based on what they usually refer to as an enterprise agreement. So customer A might have a certain package in terms of total cost, duration, is it prepaid, number of users, and things like that. So what we also want to be able to analyze within the SaaS world are those kind of enterprise level agreements. Now, fortunately, within the SaaS content, we've got another type of revenue module that we refer to as our large contracts module. And what we're going to do now is drop that in and just load that up with 4 contracts, just so that you can kind of see how that works. So if you head back to the historical income statement, what we're going to do is right click, add a 4th revenue category, and we'll label this up large enterprise users. Now what this is going to do in terms of behavior is it's going to create another copy of our upfront payments users module. So we're then going to hop across to that, and we're going to replace that with the large contracts revenue mechanism. So activate the SaaS worksheet, scroll down to the large enterprise users, and again, Modano tab, replace button, replace from web, and we're going to choose SaaS revenue large contracts. Now, after replacing this module, you can see that the large enterprise users component now contains a new category block that allows us to model individual contracts in terms of volume, value, duration, are they prepaid, underlying number of users, and things like renewal rates and probability of being struck. What we're going to do in this instance, and again, we've got the information ready to go, is we're just going to right click, add another category, and we're going to copy and paste the information in from the forecast data sheet around these large contracts. Now, a few things just to note in terms of how you might actually use these. You don't necessarily need to assume that the same contract is always used on the same row. So in some instances where we think the contract might materially change from one structure to another, what you can easily do is actually just put in a renewal rate of 0% and then enter on a second category, an entirely new contract structure with the same name, but all the new metrics that relate to this materially different contract. Now, part of the issue with this is that this might affect your metrics in terms of what is new versus renewal. But to a certain extent, if there's a material change in the contract, it might easily be considered to be a new contract. Another thing to consider is what constitutes a user. So some people will use the SaaS content and assume that the user there is a single user, and that is at the enterprise level. Another way to use this is obviously to assume that the number of users are associated with that enterprise agreement. So you could spend a lot of money to get one large user, i.e. the enterprise organization, on board, and consider that the way you want to look at your metrics. You know, that expensive meal we took the client out for is the cost of getting our user on board. Or you could assume that that expensive meal is involved in getting the 30,000 users on board. So yeah, a little bit of optionality there in terms of how you might want to use the users metric, and this will typically tie back to things like corporate policy. And the other thing to consider is that this is obviously all very modular. So to the extent that you want to model out different products, different geographical regions, different divisions and things like that, you don't necessarily have to just insert one large contracts module. You could have a multitude. So let's say you had 4 different products and they were all being sold to different geographical locations. You could put in 4 large contracts modules and actually have those split out. And what we'll see in a moment is, in terms of the financial statement impacts, those lines will actually be disaggregated much more readily. So yeah, modular system, feel free to use more than one large enterprise kind of contract module. Now, it's also probably worth just expanding out the large contracts analysis, because what you'll be able to see here is quite specifically how we work out things like the revenue invoice, things like the revenue recognition. So if you struggled with the previous example of deferred revenue, it might be worth putting in one single contract into our large enterprise users analysis just to see how that contract works in terms of the creation of deferred revenue, the recognition of that revenue, the cash receipts and things like that. Now, the last thing just to note is that if we hop across to the financial statements, which is 2K via the table of contents, if we expand the revenue at the top, what you'll see is that even though we might have a whole stack of very detailed enterprise users, we don't necessarily want to see that in our financial statements. And so in this instance, what you can see is our 4 contracts have been compressed down to a more financial statement user-friendly structure with a single line of just all of our large enterprise users. Now, the last thing to do here is just to check that we've entered the information correctly. So just confirm that the closing net assets at the end of December 2021 equals 13.124 million. And if that's all working well, then the next thing we'll look at is the cost side of SaaS businesses. Now, in addition to the revenue side of SaaS businesses, the cost side is obviously also of kind of keen interest. But there's a particular kind of lens that gets put on these things. And this relates to what's referred to as customer acquisition costs. So what SaaS companies are always looking at is effectively how cheaply can I acquire customers. What we'll do in the first instance is we'll go through a population process and we'll loop back to the metrics and the interpretation side afterwards. But as we go through this process, keep in your mind's eye what we're trying to get to, which is ultimately trying to understand, well, how easy is it and how cheaply can we acquire our customers? So the first thing we're going to do is hop to the historical income statement, and we're going to copy and paste in the OPEX numbers from our historical assumptions worksheet. So salaries, marketing, admin, and followed by that, we're then going to get the forecast numbers in. So activate the revenue and expenses worksheet, which is 2E via the table of contents. And we're going to copy and paste the forecast assumptions for the operational expenditure across from the assumptions workbook. And obviously, to the extent that a different driver-based approach might be required, it's very easy for this OPEX module to be replaced, duplicated, more modules inserted, and so on. What we're going to do from a cost of goods sold perspective is actually look at a fairly specific and a fairly continuous mechanism that we see in the real world, which is a per lead mechanism for forecasting out that cost of goods sold. Just to unpack that a little bit more, a lot of people these days will advertise through something like Google or LinkedIn potentially. If you imagine the mechanism that we're talking about there, you get charged on a per lead basis. Now, in terms of the SaaS content, all we've done is created a few more additional driver-based modules that allow us to reflect that. So what we're going to do here is insert the per lead version of our cost of goods sold modules. So in the first instance, let's again, on that revenue and expenses worksheet, just select the cost of goods sold module. And again, go up to Modano, replace from web, and we're going to drop in the cost of goods sold SaaS per lead module and start to populate that with some more specific data points. So after replacing the module, we'll just activate the historical income statement. We're just going to dial the cost of goods sold back to one category, and we're just going to label up the first category as Google Ads, and we can right click and then delete the other categories because we've only got one main data point. We'll also obviously transfer in all of the historical cost data, and that'll become relevant for some of the metrics that we'll look at shortly. So if we reactivate the revenue and expenses worksheet via 2E of the table of contents, we've also been given a notional cost per lead, which is going to be your kind of Google cost per click type metric. So copy in the $5 from the forecast assumption sheet and just confirm that the final cost of goods sold number for December 2021 is 810.5K. Now, in entering a cost per lead, we've actually triggered an alert in the balance sheet due to the creation of negative cash. And this is a fairly normal aspect of SaaS modeling. To the extent that we're pumping a lot of money into a business to try and win new market share, that obviously requires some funding structure. This is outside of the realm of the course we're looking at here. So what we're going to do is just hop across to the alert check, and we're going to just turn the balance sheet alert check to no, just so that we're not being flagged by it. But obviously, you'd be looking at a whole bunch of startup type funding processes that we'll be covering in future courses. Now, the last data entry we need to do for the customer acquisition costs is to actually, allocate these costs themselves to that process. So if you activate the customer acquisition cost worksheet via 2D in the table of contents, what we're going to do is reduce the number of categories down to just a single customer acquisition cost. And then what we're going to do is transfer in the all periods assumptions from our all periods assumptions worksheet in the assumptions file, and just have a little bit of a chat about what this now kind of represents. So in terms of these assumptions, what we're trying to get to is how much does it cost me to acquire a customer? And what we're basically saying here is, well, all of our Google ad spend is related to acquiring customers, half of our salaries relate to that, and all of our marketing spend. And by allocating these costs into a customer acquisition bucket, we can start to understand how expensive our customers are in terms of acquisition. And this is what we're kind of building up to. So before we get onto the dashboard side of things, which is really the kind of the icing on the cake of this entire course, just confirm that the cost to acquire a customer in December 2021 is forecast as $1.1234 million. Now, at this stage, we've got a model that's comprehensively populated. So we've got all of our revenue analysis in there. We've got all of our cost analysis in there. It's now time to kind of have a look at the implication of those numbers in terms of the types of outputs that most SaaS people and the firms investing in SaaS companies are most interested in. Now, if you hop back to the table of contents, there's a comprehensive metric sheet contained within the analysis. So that's in position 1C of the table of contents. That gives you a very detailed kind of granular numerical tabular kind of structure. The more interesting thing in terms of understanding the who, what, where, when, and why of SaaS modeling is probably to have a look at the SaaS dashboard itself. Now, in terms of this dashboard, the main SaaS dashboard is looking to try and tell basically the story of the company. It's designed to be read top left to bottom right, and each of the rows is trying to address a certain part of the analysis. So on the top row, what we're looking at here is really what's happening from a user-based perspective. The second row is then looking at how we might kind of monetize that and the value associated with those users. And then the bottom row is actually then trying to wrap that together and ultimately to get us to a fairly important metric, which is the LTV to CAC ratio. So in terms of the first row of the analysis, this is all based around kind of user performance. So the first thing we're looking at is kind of leads and conversion. How good are we at converting those leads into kind of new users? Now, off the back of that, that's going to give us obviously an absolute set of custom numbers. We also want to know how we're doing in terms of growth. Has our growth metrics itself slowed down? How are we looking from a history into forecast? Are we plateauing? Is this thing accelerating? Off the back of that, we then trying to get to new versus renewal users. So they're slightly different metrics, but all form part of that overall view of the users. And the fourth and final chart is related to that churn rate, and that will then flow into the second row, which is really looking at the value of the user base. So from a churn perspective, obviously we don't want our churn to be increasing. That means that our product is getting less sticky and people are being less impressed with it. If that churn rate is declining, it means that we've got a better and better product that nobody ever wants to leave. So churn rate is an incredibly important metric and one of the key things that people look at for the reasons we'll get to at the end of kind of the next profile. Now, in terms of the second row of analysis, this is looking at the value of the user base. So monthly recurring revenue is just trying to get to, how are we doing from a fundamental dollar generation perspective. By comparison, ARPU is looking to actually say, well, in terms of the customers we have, are we getting more out of them, or are we cannibalizing our own performance with kind of lower revenue numbers? Are we sacrificing price for volume, or are we monetizing people more efficiently? The next piece then looks at kind of EBIT to user. And what this is really trying to say is, what kind of value are we getting out of these users relative to the overall kind of performance stack of the business? What we're looking for is obviously an incredible amount of income for any one user. Now, the EBIT to user metric is incredibly important because if we use that and our churn number, we can start to get to a long-term value. For anyone in the property sector or anyone that's done kind of, bond yields or something like that, if you take that EBIT per user number and you divide it by that user churn rate, you can get to how much value that customer will be in terms of a lifetime of value. And this is an incredibly important metric for SaaS companies. Your customer LTV is basically saying that individual is worth a certain value to this business. And in terms of why that then becomes important, we then wrap that together in the third row of the dashboard, which starts to get to the LTV to CAC ratio. So this is all about kind of the holy grail of SaaS modeling. So we'll just run through the third row in the first instance. Closing cash doesn't necessarily relate too much to some of the operational metrics, but is obviously a fairly important thing for people to be looking at. The second chart on the third row is your customer acquisition costs. From a private equity perspective, in terms of an investment, your ideal SaaS company is one that simply spreads virally. It costs you nothing to acquire those customers. So that customer acquisition cost becomes an incredibly important metric in its own right. However, if we then combine that CAC per user with our long-term value and look at the ratio of those, this starts to get into one of the final metric that most people will be trying to look at, and that is your LTV to CAC ratio. And what this is looking at is what is the value of my customers relative to the cost to acquire them. So again, if we relate this back to our original example, which is a Netflix style business, if you think about Netflix as an LTV to CAC ratio, not many people cancel their Netflix subscription. So, they have a very low churn rate. They have a reasonable monetization of those individuals. So, with that low churn rate, we can assume that everyone is going to be using Netflix kind of forever. From an LTV perspective, that gives you an incredible amount of value per individual. Now, if you also then think about how you potentially found out about Netflix, you probably didn't see a Netflix advert. You might well have heard about it from a friend, somebody talking about a show or something like that. To that extent, Netflix doesn't really have to spend too much money on advertising, and therefore its cost to acquire any one individual customer is much lower. So when you look at Netflix share price, a lot of that is driven by a function of this kind of LTV to CAC mentality, whereby we've got a great user base that we're monetizing well, and that user base is going to be around for a long period of time. We've also not having to spend too much money to acquire new customers. And so, this is really what that dashboard is trying to tell the narrative of. So for any SaaS company you're looking at, we're ultimately trying to get to, the value in that ultimate ratio. Now that largely completes the core part of this SaaS training exercise. We'll just have a quick look, however, at the scenario analysis. So in addition to a few additional charts of accounts, we've also created a whole stack of scenario-based analysis where you can start to, sensitize and run scenarios on different churn rates, different user growths, and things like that. So if you just want to hop across to the Modano tab, we'll click on the open button and select one of the example models. And what we'll choose is the SaaS scenario analysis model, and this is the multiple pricing model. So this is actually a model very comparable to the structure we built. And indeed, the 4 modules that are included in this particular example model are the same 4 modules that we've used here, only they include the scenario assumptions. So for example, UCAN is our users rates example, but in addition to having that core piece of analysis, there's also the potential to put, changes in your conversion rate. So, what if we're doing better at converting those leads across? And again, we've got, in this instance, base case, upside, downside. In addition to that, things like growth in users, user churn. So we can run scenarios and packs of analysis on our kind of base assumptions. Now, if you just click on the intercomponent hyperlink in column A, this will take you across to the assumptions. This is comparable to the rates users module that we were using at the top of this exercise. So the SaaS scenario content is a fairly natural kind of extension on from the SaaS content itself, also kind of wrapping in the comprehensive scenario analysis content that we've already got out there as well. So definitely worth having a look at the scenario course, as well as obviously having just worked through this piece to kind of get the best out of both worlds. And just to leave you with a little bit more candy, the scenario analysis, as you'll see in those training courses, is pretty comprehensive in terms of its outputs. So if you just hop back to the table of contents and select worksheet 1E, which is the SaaS scenario summary worksheet, what you'll see here is the concurrent presentation of all of those scenarios on a live and kind of dynamic basis. And so moving on from, obviously this model still has that kind of core dashboard that tells that narrative. This allows us to tell that narrative across multiple instances. So certainly, putting one of these models up in front of an investor is it's going to give them an incredible amount of information in, again, a single one pager. So there you have it. Hopefully this was a fairly painless process to go through. In a lot of instances, SaaS modeling can get quite complex and quite chewy. If you're talking about that Netflix style model, though, hopefully, it's an A times B principle. All right, there's a corkscrew kind of churn calculation, but the fundamental metric's not too kind of complex to deal with. Deferred revenue is really kind of where a lot of the complexity comes in. But as mentioned earlier, we have automated a lot of that structure. So your task here is really, it's largely one of interpretation and kind of use. So there we have it. If you've enjoyed this, then feel free to hop across and have a swing at the practical training exercise, which runs through a fairly similar kind of process. And there's also a whole stack of theoretical questions as well. But otherwise, thanks for joining us.